Hello ladies and gentlemen, thank you again for tuning in to Ascending Abundance YouTube channel. My name is Pavel Spurdlin, CFA CPA, but I'm not a financial planner, and this channel is only for information purposes. I'm exploring various strategies on how to make more money with the existing capital that we got. Today, quick update. I'm gonna share one strategy that I'm deploying, but also just want to quickly run through what's happening. So the overnight repo facility continues to be drawn down. We're under 1.1 trillion by now, 1 trillion 90 billion. That is nearly half, or actually more than half, of where we used to stand just in May, June. So another 3 months of this, and the extra cash in the Federal Reserve reverse repo is going to be completely drawn up, and there's going to be nobody else to continue buying those treasuries, and that's when I expect Fed to step in. They're going to start buying treasuries because nobody else is going to buy trillions and trillions and trillions, right? The deficits are running at roughly $2 trillion for US government, and nobody else, I believe, will have that much cash sitting aside, just keep buying them. So, and the interest on those debts are continuing to accumulate. So we're still probably 3 to 4 months away from this pile being fully drawn out. Meanwhile, Federal Reserve is not reinvesting his money or their money in the treasuries. They're running them off. The balance sheet continues to decline. We're below 8 trillion by now. They've run it off nicely. If you look at the past year, it started nearly at 9 trillion. Here's the peak. We did not reach 9. I don't see we reaching 9, but almost 9 trillion, and now we're below 8, so that trend is kind of intact. Nothing new there. The M2 money supply, which is 94% correlated with the stock market and risk asset returns, continues to go down. We just got the September reading in October 23rd, I think, or 24th. That's when the update came in. So in September, we have less money in the system than we have in August. So those treasuries that are being sold by US government, they are being bought with the reverse repo and any other cash on hand. That cash continues to be spent, but overall credit in the economy is shrinking. Fed's not issuing anymore, and I'm guessing the commercial banks and various corporations are not issuing any more debt at these levels. So the money supply is shrinking, therefore the assets are also kind of vulnerable and are just declining, and that's why we're seeing Nasdaq and S&P 500 going down. But I'm looking also, of course, outside. How do we make money? So you can short SPY and QQQ and kind of follow Michael Burry on it. But I'm hesitant to short US stock market. Overall, that thing has been going up for decades. Timing it is really tough. I mean, it's possible, but it is tough. Instead, I'm looking at Bitcoin. So Bitcoin is an asset that is closely tied to the capital markets lately, but in general, it is not really tied to the capital markets. It has a life of its own. There are different dynamics. There is some correlation, but it's by far not perfect, which makes the risk of holding crypto a diversification tool for somebody. So I am looking at it from a diversification perspective, but also thinking ahead of the ETF announcement. So ETFs are going to be, a decision are going to be done somewhere prior to January 10, 2024. So we got a couple of months until then. We probably gonna see Bitcoin skyrocket shortly after, because everyone, Fidelity, BlackRock, all the other ETF providers who will be approved, if they're approved, are gonna start selling Bitcoin to their audience, to their investment advisors, who will then sell it to their clients, to mutual funds, maybe even ESG spin on it, so environmental and social governance funds, whatnot. They're going to start pushing Bitcoins precisely on this premise of Bitcoin being somewhat disconnected from the markets. Like, look at it, right? It goes down while the market go up. It goes up while the markets are down. Like, there are these common themes where they both run in the same direction. So Bitcoin over the long term obviously fluctuates way differently than other assets, and therefore this will be sold to investors as diversification. And because Bitcoin is obviously a limited supply asset, it will probably have to skyrocket, because no one would want to sell. Everybody would want to just hold and see the prices go up. Meanwhile, those ETFs will probably see some few $1 billion flowing into them. They would need to buy. I don't expect like a radical jump. I just expect sort of a slow progression with occasional jumps. Because those ETF providers probably have plans in place as to when to start accumulating Bitcoin. They might be already accumulating some Bitcoin, and I don't think they will just all of a sudden jump into the market and start buying billions of dollars of Bitcoin. It's more likely they will use up some reserves that they have, or some contractual agreements with the Bitcoin miners to stuff up their portfolios. So there will not be an immediate demand. There will be a jump from speculators like myself, investors, who might want to foresee and kind of front run the spike. But the providers themselves will initially probably use some sort of contractual agreements. Then, when that's done, they will have to, if the money is still flowing into those ETF, they will have to start buying on the open market, and that's going to truly drive and jump the asset price. So hopefully we'll see some of that in the coming months, but that's in January. And in the meanwhile, money supply is declining, and Nasdaq and S&P 500 are down since, let's say, July, or if we look at, well, let's say end of August-ish, we're looking at minus 8% roughly, while Bitcoin is plus 15%, so go figure. So kind of keep watching that. Another useful tool on Bitcoin is to see their NUPL, net unrealized profit and loss. You can find it for free at Glassnode websites, and we are now in the optimism territory. We're driving up from the capitulation. We're going back up. The price of Bitcoin, though, still, ways to go. So we're in a somewhat hope, past the hope and into the optimism phase. The next piece I want to just share is to say I am also looking at playing natural gas. This is one of my favorite plays. I don't always make money on it, obviously. Nothing's guaranteed, but BOIL is an ETF in the United States. That an HNU would be the Canadian version. This ETF invests in futures of natural gas. But if you think about futures, the expectation of a cold winter is almost always there. There's always expectation the supplies are going to run out. So the futures of natural gas are naturally incorporating some piece of potential upswing, potential uncertainty. And they're always higher, almost always higher than the spot prices. And if you keep rotating those futures and selling like today's future and buying the 1 month forward and wait to today, sell it, buy the 1 month forward, unless there is a huge jump, you're steadily losing money. This thing loses money at the tune of 40 to 90% a year. And you could see, let's say 10 years ago, that was at 240,000 per unit. That's bullshit. It's not. Just every couple of years, the price of BOIL goes down so much that they have to do a reverse split, let's say 4 to 1, or 3 to 1, or 5 to 1, or even sometimes 10 to 1, to prop up the price to something meaningful. And that's why the charts need to go back in history and adjust their prices. So you can see there's gone down to 20,000 and gone down to 1,500. That's all because of the splits, the reverse splits. If we go into sort of today's territory, for some reason the volume is interfering here, so hopefully maybe we can silence the volume. I don't know, let's just silence the volume. No, I don't understand why this range is not allowing me to see it. So can we go in? No. Anyway, unless you see some sort of spike like this, so be aware. BOIL could go from, say, this is 500 all the way to 2,500, right? So it could 5x on you. So if you short BOIL, which is what this graph is suggesting, really, if you short BOIL, and we all should, in a sense. Be aware that you could be caught in a spike like this or a spike like that, and you could really be taken out. So if you're shorting oil, one of the suggestions that I use and the strategies that I use is I sell spreads. So for example, right now it's trading at $64. So I would sell a call option at, let's say, $85. But that exposes me to huge risk because of the volatility. The premium on the $85 call option is pretty good, but then I want to limit my upside. I want to limit that tail end where oil could just skyrocket and take me out and go 5x. So I might sell, let's say, a call option on 85, but then I buy a call option on 105. That gives me the $20 spread, which is my exposure. It's limited. If all of a sudden there's a spike in natural gas, I will only lose the 20 bucks. But the difference in premium on that spread is fairly nice. So I've calculated that if we sell spreads, let's say with a 60 days out time frame, you could be making anywhere between 45-50% annual rates of return on the risk that you're taking. So please limit your upside risk. Well, I guess that's the downside risk, the risk of oil really skyrocketing on you. Put that cap, pay that premium, that's okay. It limits your profit, but it also limits your exposure majorly. Once I got caught and lost a lot of money, so since then I do it. And if you are somewhat successful in picking the time frames and nothing terrible happens in the energy markets, you could easily be making 50% rates of return with this strategy while also limiting your risk. You can clearly calculate that exposure, and if you're sensing that the weather is turning and something's happening in the markets, you can always get out of that spread position by, let's say, limiting the premium exposure to, let's say, 2x. So if you got 100 bucks for that spread, if all of a sudden prices start spiking, you're foreseeing that continues, then you can close that spread with maybe a loss of, say, $200, right? Like, put yourself a cap, keep monitoring your spread, and get out of it if you feel like you are on the wrong side of the trade. So protect yourself that way, while keeping in mind that oil is designed to fall. So unless you get caught up in one of these spikes, you're gonna be okay. The other option is obviously to wait for the spike, wait for oil to 5x, and then just plain freaking short it. Challenge is you never know when it's going to end. So this particular spike shows from 5,000 all the way to 15,000. That's actually, this is a 3x. This is a 5x. So it has its limits too, but you don't want to test those limits. That's what I'm saying. So leaving you with this oil strategy, hopefully that works. For NASDAQ and S&P 500, I'll be cautious. I'm sitting on somewhat of a cash position. I'm still waiting for the craziness to subside. I want to see Federal Reserve step back into buying the treasuries. They should stop running off their balance sheet because nobody else is buying treasuries, so they're going to have to. And once they acknowledge that, and they're going to start playing their games of somehow calming the markets and keeping the interest rate yield under control, maybe playing in the long range treasuries, not just the short-term rate that they keep on fluctuating up. That's when I think we will see good entry points for NASDAQ or S&P, and that's when we may buy some more companies. Meanwhile, take a look at the fixed income, take a look at oil. This one does not depend on the market whatsoever. This is pure energy, so it gives you just yet another way of making money with your capital while you wait for the regular markets to subside, or for the Bitcoin to be approved, or for whatever else your favorite strategy is. Meanwhile, thank you so much for listening. Do subscribe, hit the like button, leave a comment. Love those comments that I've gotten so far. Much appreciate everybody's time, and do support the channel. Thanks, guys. See you.